Good morning, and thanks so much for tuning in. You're watching BQ Prime. Now, look at the equity markets globally. There's understandably some caution ahead of the outcome of the latest Fed meeting. There's widely expected to be another 75 basis point hike. But more importantly, I think people are looking for the commentary of the Fed. But if you zoom out and you look at the performance over the last month or so, equity markets have more or less moved along the same lines as was anticipated by a lot of technical analysts globally. The bounce that you've seen in equity markets in the US and, of course, in India. But the question I think that a lot of people are asking is, has the US market bottomed out? What does that mean for emerging markets and certainly our market here in India? So, to that end, it would do us a lot of good to have a global view. And it gives me a lot of pleasure to introduce my guest this morning. I've got Dave Lundgren, who is someone who's got over 3 decades of experience in the industry and with a very keen focus on technical strategy. He's currently portfolio manager at the LHA MOTR Long Short Fund and the founder and chief strategist of MOTR Capital Management and Research. Thank you so much, Dave, for taking the time.
It's my pleasure to be here, Alex. Thanks for having me here.
All right. I want to actually stand on your shoulders, so to speak, and talk about the last 3 decades. Not necessarily about the last 3 decades, but last couple of years. A lot of people have used the word unprecedented. But from a technical standpoint, my question to you to start this conversation is: do you see parallels in how the markets have performed, how they're behaving? And do you anticipate that they will follow similar patterns to what you've seen over the last 3 decades? What parallels can you draw?
I mean, I think unprecedented in the markets is probably a strong word, just because so much has happened over the past 100+ years. But I think you can say for sure that that what happened with the COVID situation and how violently the market responded and how deeply the economy corrected, and of course the central bank response to that was largely unprecedented. So it made for a very uncertain environment. But at the end of the day, that's also one of the reasons why I think it pays to really listen to the message of the market, and it's why I've devoted my life to really trend following and momentum investing. It's just the best way to really, at the end of the day, the market's the best analyst on the planet. And I think for those that are technically oriented and are willing to listen to the market and observe trends, we're able to actually, you can navigate unprecedented environments by just listening to the wisdom of the market vis-a-vis trends. So there's no question that over the past, couple of years, it's been unprecedented behavior. But at the end of the day, what we do find, and you can actually reflect back on what's happened in the past couple of years, and in many ways, although it's accelerated, maybe things are a little bit faster. Trends are trends, and so unprecedented, yes, but not navigable. I would say no. It's not a case of not being able to navigate it. You just need to be much more responsive than what's typical of a more traditional sort of secular bull market.
So, understanding the pulse, I would call it, right?
Yeah.
Being agnostic of what I think a lot of people are saying and looking for patterns. So,
Right.
from that perspective, I think I'll go back to the main question that we're asking is: has the US market, in your opinion, based on the technical indicators that you follow, bottomed out? I think a lot of people called that bounce that happened mid-October onwards, and whether or not that is forming a base. And what does that mean for the Indian equity markets and indeed emerging markets?
Yeah, I mean, I think we can say for sure, well, you can never say anything for sure, but I think we have enough evidence to suggest that the market's in a position to put in a bottom, whether it's the bottom for the bear market that we've been experiencing this year, that, the jury is out on that. But I will say that the technical conditions, normally when we have an oversold environment, I'm actually quite willing to just buy an oversold condition, with the market having sold off from its highs. But in this particular case, and I don't mean to be an alarmist at all, because I will absolutely change my mind if the evidence changes. But I will say that in this particular case, the degree of deterioration beneath the surface and the magnitude of deterioration beneath the surface, when you look at things like from a micro perspective, one stock at a time, it is in many ways, it's as bad as what we saw leading up to the global financial crisis. And so what I mean by that is that you normally in a correction, even in a cyclical bear market, you don't typically see long-term monthly charts break. Usually it's more like the daily charts and the weekly charts that are really upset by emotional response to the possibility of bad fundamentals looking forward. But all that emotional energy that upsets the trends on the short-term charts leaves intact typically that long-term monthly chart. And ultimately, those long-term monthly charts those are driven by fundamentals. And so what I've always believed is that as long as we can go through these corrective periods without actually impacting those long-term fundamentally driven monthly trends, we're fine. And for most of the bull market since the global financial crisis, we could say that most of those corrections really left unscathed those long-term monthly charts. But this particular correction has actually done quite a bit of damage to those charts. So that doesn't mean that the GFC type of a scenario is to follow, but it does mean that I'm a lot less inclined to just buy oversold conditions just because we're oversold, because we're really no longer in an uptrend. That's, I think, is the takeaway.
Okay, so from that perspective, you're not really calling a bottom. A base is currently forming, and I know that you put that caveat out. You said you don't
Yeah,
want to sound alarmist, but
right.
we could, in fact, see significant selling if the event arises. If, for example, a Fed says, contrary to expectations, that it is going to stay hawkish, it's going to stay the course. I think a lot of market participants anticipate a softening of stance. So, for example, if that doesn't pan out, do you think that that will lead to a lot of selling and that will change the way that you perceive the charts?
Yeah, I mean, Alex, I think you hit the nail on the head the way you described it. The way I've always viewed trends is as long as those long-term trends are still intact, what it reveals is an underlying positive outlook as interpreted by the market. And of course, that's the wisdom of the market is the sum total of all of the smart and not so smart people that are involved in the markets. But as long as those long-term trends are intact, it's revealing an otherwise very healthy fundamental condition. And when you have oversold conditions with that as a backdrop, I'm a lot more inclined to be willing to buy those oversold conditions. Right now, where we've actually seen enough deterioration in those long-term trends, it's a warning that the fundamentals are deteriorating enough such that when you can take in a strong secular bull market where you have those long-term fundamental trends intact relative to what we have today, you can take the same exact fundamental news item and filter it into one environment where it's a bull market, and take that same exact news item and filter it into an environment like we have today, and the market will respond very differently because the two trend conditions are very different. So what I mean by that is that the current conditions in the market are reflective of a market that's inclined to go lower if we have incrementally negative news from here. So I think there's reason to believe we have a tactical low in place. If we're looking at the S&P 500, maybe 3,900 to 4,000, somewhere in that vicinity. But below that level, I'm really not willing to take on the maximum exposure that I could typically take in the funds that I manage. Still
Okay,
being
fair
very
point.
cautious.
Okay, so caution is the byword right now.
Yeah, yeah.
Let's talk about the dollar, because I think a lot of people have focused on that asset, on the currency. A lot of people are asking from the perspective of other asset classes, also gold in particular, because
Mhm.
that move generally happens in tandem. Has the dollar index, in your opinion, based on technical indicators, peaked out?
I would say from again a tactical perspective, if you see this chart here, you can see that the index has been trending since the global financial crisis. That's that low in 2008. So we've got the sort of ascending channel, pretty well containing the price action since then, and we're at the top of that channel. So it makes sense that right here we would pause. If you look at the lower panel, that's just the 52-week rate of change, basically the momentum of the index over time, and you can see that it's definitely in this danger zone where you at minimum get some sort of a high. If it's not a major high, certainly a tactical high. So if we were to get a pause in here, that would not surprise me. But one of the things I would want to point out is that if you look at the long-term trends of the dollar versus most of the major crosses, I mean, it's actually in a bull market. So a lot of the pushback that you get from folks who look at the DXY index, which is what you were just looking at, is that the first thing they'll tell you is, well, that's mostly the euro. That's not really revealing what's happening to the dollar. But if you actually dig beneath the surface and you look at the trends across multiple major crosses relative to the dollar is in a major, as I alluded to earlier, fundamentally driven long-term monthly uptrend relative to almost every other cross. I think it's the only three crosses where the trend is not clearly up would be the Mexican peso, the Brazilian real, and the Russian ruble of all things. So beyond that, it's in a very clear uptrend against all those other crosses. So if we do get some sort of a pullback, see, that's the difference between where the dollar is and where the U.S. market is. Those trends for the dollar are clearly up across most of the major crosses. So any weakness in here, I'd be very willing to buy weakness in the dollar. Whereas when you look beneath the surface of the S&P, most of those trends are down. And by most, I mean almost 3/4 of those major fundamentally driven trends are actually negative right now. That's what makes the current environment very different from any other pullback that we've seen since the global financial crisis. And I would even put the COVID sell-off, because that happened so quickly and we responded so quickly off the lows that we actually didn't do the same kind of damage that we've actually done off of this high. So the underpinnings of the dollar strength is the breadth of that strength is quite strong. So any weakness that we did see off of that channel high, I'd be inclined to be a buyer of it.
Very well put, and I think that very nicely contextualizes what you were saying about the equity markets as well.
Right.
But I think people are looking at other commodities very closely as well, David, across the world. Of course, a lot of this is driven by supply-demand factors and decisions by major suppliers, say, of natural gas or of crude oil. But any interesting trends on the technicals that you're seeing in those commodities as well?
So I actually track all of the asset classes, and for about a year, if you just observe the breadth of the I guess the percentage of a particular asset class, it's in a primary fundamentally driven, long-term monthly uptrend. For about a year, the commodities space, or as an asset class, commodities have been at the very top of that list. And I would say in the last several months, it's been slowly eroding. And what you're actually finding at the top now is the dollar as being at the top of that list of best trending asset classes. And at the bottom of the list, of course, as you can imagine, over the past year has been equities. So what we've been seeing more recently with the bounce in equities, particularly in some of the emerging market equities, which is interesting, and the sell-off in a lot of the commodities across the spectrum, really, is that the gap between the performance of commodities is starting to close versus equities. And so I guess on the one hand, that might be a positive indication for potential for equities going forward. But at the end of the day, again, those long-term trends in most of the commodities is still strong enough, and the breadth there is still strong enough to suggest to me that I wouldn't be shorting commodities here. That's for sure. And actually, if you look at some of the relative performance of the equities that are tied to commodities, whether it be countries, as I just mentioned, the three currencies that I told you that are strong relative to the dollar is Mexico, Brazil, and Russia. Those are commodity-based countries, and those are the only three positive trending currencies versus the dollar. And then when you look at the relative performance of the energy sector in the U.S., if you look at that long-term trend back to the global financial crisis, it's been in a downtrend since then. But more recently, as strong as the energy sector has been over the past couple of years, it's actually only just broken its downtrend. So if you look at comparable developments like that in the past, in the early 2000s, a similar trend was broken, and that gave way to almost a decade-long uptrend of performance from a very inflation-sensitive sector like energy. And so energy has broken its downtrend. In the other sector, of course, that you'd want to see break its downtrend to indicate that it's benefiting from inflation or benefiting from commodity trends would be materials. And that, too, is now testing its more than decade-long downtrend that's been in place since the global financial crisis. And again, I think if you take that downtrend out, along with energy having just done that just recently, then that would be a pretty strong message from the equity market that inflation-sensitive equities are what are set to lead uh, the equity market going forward.
Interesting.
Yeah.
You are in India right now, and
Mm.
I think you've been looking at the India market a lot more closely than you would normally do. I think that's safe to say. But having said that, I was speaking to somebody recently who is also a proponent of the momentum strategy. And what he was saying is that he's not yet confident that he can play that full tilt. He has seen sideways movement over the last few months in the Indian equity markets. I'm curious to understand what you think about the trends and the sector rotation that we've seen over the last couple of months. How
Yeah.
do you read that right now?
Well, to me, like I think it's hard to keep focused on what matters most when you're in the throes of a lot of uncertainty and bear markets and the capital loss and et cetera. And at the end of the day, you have to keep discipline to your process. And to me, what I'm constantly looking for during bear markets is what's performing better than I would expect it to perform given the environment. And examples of that would be like in the global financial crisis when unemployment was in the north of 10%, depending on which measure you use, and the economy was crashing, and risk assets were obviously for sale at that time, as we all know. In that moment, what was surprising to me was that the consumer discretionary sector, which is basically benefits from all these from consumers, and presumably they're all in the unemployment line. Despite that, despite all the concerns and fears, the consumer discretionary sector actually was one of the best performing sectors during the global financial crisis. And also at the same time, a very risk-on sort of growthy industry within the market is biotech. And during the global financial crisis, all these things went down, but these two sectors went down less than the market. And don't you know, when the market bottomed in 2009, after the initial bottoming phase, what actually went on to lead the market, of course, sharing leadership with a few other sectors, but for sure, some of the strongest leadership came from the consumer discretionary sector and biotechs. So the market has a way of tilting its hand and showing you its cards in terms of what it's sort of discounting for the future. And I think it just pays during these crisis moments, if you will, to really pay attention to those parts of the market that are actually doing better than you would anticipate. So all of that is to say, when I look at the markets today and I'm trying to find those things, what really jumps out to me is how strong the Sensex has been, equities here in India. If you look at this chart here shows you this chart here is showing you the in the top panel is the Sensex relative in local currency relative to the S&P in local currency. So there's no currency effect in here. In the middle panel, that is the rupee relative to the dollar. So when you see a declining line there, that indicates that that's rupee strength. So this is the USD INR. And so you can see that when the rupee is weak, or that line is rising, the Indian stocks tend to underperform the U.S. market, and we know this. Whenever the dollar is strong, that tends to be a headwind to emerging markets. And so you can see that playing out here. And if you look at the bottom panel, that's showing you the rolling 52-week correlation between the relative performance of India stocks relative to the U.S. In its correlation to the USD INR. And what you can see, there are moments where it's positively correlated, but for the most part, you can see that red line in the bottom panel there, that's zero. Anything below there indicates negative correlation, which is, again, what you would anticipate. But when you look today, where I have that circled, that's showing you that the current correlation is 91.91 or 91%. So that indicates that the correlation, if you look across the chart, this is the highest positive correlation that this relationship has had in the past 20 plus years. So this is really what you're asking about, unprecedented, at least in the last 20 years. This is the highest positive correlation that we've seen. So what I find interesting is as strong as the dollar has been against the rupee, you can see the chart in that top panel, how the Sensex has been, regardless of that, has been outperforming the S&P 500, which I think is something that, again, is in terms of the market giving you one of those tells as to what is likely future leadership once the dust settles in this crisis that we're in. I want to be really mindful of being open to owning emerging markets with a special eye on India, because it's been incredibly strong.
Okay, so that's the word on India. Last words, Dave, and here I'm going to ask you to talk about, say, for example, what happened in the UK recently. I think a lot of technical analysts depend on data, and you said that it's important to focus on the patterns, but things change so sharply, so dramatically. You have an overnight crash in a currency. You have bond yields that go lower by over 30 basis points one day, and they're up just about a couple of weeks later that same amount. How do you deal with that, especially, for example, if you're a momentum trader? Where do you, how do you gauge that?
Well, I think if you can do this within your mandate or whatever, however it is that you're managing money, what I find um, the best, frankly, the best solution for that type of an environment is to just walk away. So I don't have to trade stocks in the UK. I don't have to trade the British pound and be exposed to that volatility. So I'm happy to be exposed to volatility as long as it's trending. As I said earlier, I'm willing to buy weakness as long as that trend is still intact. But the European market has been in a bear market since 2000, and particularly if you compare it to the U.S. market, I mean, it's been, I think it peaked in 1998, I believe, and frankly, in my former role as a portfolio manager, we managed a global portfolio where we could literally invest anywhere, and some of our best performance actually came from our holdings in India. But in that entire time that I was a part of that team managing that fund, we always had very, very low exposure to Europe, and that's just a function of what's been working really since the global financial crisis bottom has been technology. And so we can say for sure that obviously the U.S. has been the leadership country since the global financial crisis. I showed you the dollar. That's when the dollar bottomed, et cetera. So you can see that the U.S. has been the leadership market since the global financial crisis. But really, if we're being honest, the reason that the U.S. has been outperforming for that long is because it's got the best tech sector. And if we're in an environment where inflation is starting to rear its head, and you can see energy stocks starting to break their their decade-long downtrend, and interest rates going through that 3% level up to 4, maybe perhaps 5% as a discounting mechanism that can have a significantly negative effect on valuations. What we're seeing now is growth, which is obviously emblematic of the tech sector, is really underperforming, and it could underperform for a lot longer and with a lot more downside between now and when it finally bottoms. And to me, that this is the beginning of what could be if we have this return to inflation, if you will. I think one of the things that's really underpinned the bear market that's been going on in Japan, in Europe in particular, has been deflation. So if we're turning the page and going away from deflation towards reflation, and economies can start to see some growth outside of the tech sector, and some of the things that benefit benchmarks that don't have as much technology in them, which of course would be emerging markets in Europe as well, then perhaps we're at the beginning of a scenario where some of these markets that have been underperforming for 20 years might be on the cusp of finally outperforming. But the volatility that you alluded to earlier tells me that the market's just not ready yet to really to really reward these markets that have been in bear markets for so long. So for me, I'm still not involved, but I'm a global manager, and to this day, I can still invest anywhere around the globe. I'm just not there yet.
Okay, but Dave, it's been an absolute pleasure speaking with you. I think we've covered a broad swath of topics, and wish you well on your stay here in India. Thank you so much for joining us.
Thanks so much, Alex.
Thanks. Stay tuned for a lot more.